So, let's talk about trading. A lot of people see the flashy headlines, the massive gains, and they think, I can do that too. They jump in, buy some stock that's going up, and then they watch it crash, having no idea when to sell. Or worse, they buy something, it goes up a little, they sell too early, and miss out on huge profits. The truth is, most people lose money trading not because they are bad at picking stocks, but because they have absolutely no plan. They're basically gambling, hoping for the best. And that's a surefire way to see your account balance go to zero. It's like trying to build a house without a blueprint. You might get a wall up, but it's probably going to fall down on you. The single biggest mistake I see beginners make is focusing only on what to buy. They spend hours researching the perfect stock, the next big thing, but they spend 0 seconds thinking about the most critical part: when to get out. Your entry point is important, sure, but your exit strategy is what actually determines whether you make money or lose money. Knowing when to sell, both to lock in your profits and to cut your losses, is the difference between a successful trader and someone who just donates their money to the market. It's not about being right all the time. It's about making more on your wins than you lose on your losses. That's why today, we're going to break down the absolute basics of entry and exit points. This isn't some get-rich-quick scheme. This is the fundamental, non-negotiable foundation you need before you even think about placing your first trade. We're going to cover how to create a simple plan, how to spot a good entry, how to decide on your exit before you even buy, and some golden rules that will save you a ton of money and heartache. So, get your coffee, smash that like button for the YouTube algorithm, and let's get into it, because what you're about to learn could completely change your trading results. Alright, first things first. Before you even open your brokerage app, you need a trading plan. This is non-negotiable. Seriously, writing it down is even better because it makes it real and holds you accountable. Your plan doesn't have to be a 50-page thesis, but it needs to answer 3 very simple questions. First, what are you trading and why? Are you trading Apple stock because you believe in its new product line? Or are you trading a volatile penny stock because you saw it on Reddit? You need to have a reason, a thesis, for why you think this asset's price will move. Without a reason, you're just guessing, and the market is very, very good at taking money from guessers. Next up, what's your goal with this trade? This is huge. Are you trying to make a quick buck in the next few hours, which is day trading? Or are you a swing trader, holding for a few days or weeks? Or maybe you're a long-term investor, looking to hold for years. Your time frame completely changes your strategy. A day trader might sell for a 2% gain, while a long-term investor might not even blink at a 20% drop. You have to define your objective because it dictates every single decision you're going to make from this point forward. Mixing these strategies is a recipe for disaster. You can't buy something for a long-term hold and then panic sell it the next day because it dropped 1%. And the most important part of your plan, the one that will keep you in the game, is deciding on your risk. How much of your hard-earned money are you willing to lose on this single trade? The rule of thumb, and please, tattoo this on your brain, is to never, ever risk more than 1 to 2% of your total trading capital on any single trade. If you have a 10,000 rupee account, that means your maximum loss on one trade should be 100 to 200 rupees. That's it. This prevents one bad trade from blowing up your entire account. It allows you to be wrong, and trust me, you will be wrong and still live to trade another day. This isn't about being scared. It's about being smart and preserving your capital. Okay, so you've got your plan. Now how do you actually find a good spot to click that buy button? You don't just buy because the price is going up. That's called chasing, or FOMO, fear of missing out. And it's how you end up buying at the absolute peak right before a crash. Instead, we need to look for specific signals that suggest the price has a good chance of going up from a certain level. One of the most basic and powerful concepts is looking for support levels. Think of support as a floor that the price has bounced off of multiple times in the past. When the price comes down to that floor again, it's a potential area to consider buying because history suggests it might bounce up again. But we don't just buy blindly at a support level. We need more evidence. We need what's called confirmation. This is where candlestick patterns come in. These are visual representations of price movement, and some patterns can signal a potential reversal from down to up. For example, a hammer candle, which looks like a little hammer, or a bullish engulfing pattern where a big green candle completely swallows the previous red one, can be powerful signs that buyers are stepping in at that support level. You're waiting for the market to show you its hand, to give you a clue that the downward move is running out of steam and a reversal is likely. It's about patience. To add even more conviction to your entry, you can use technical indicators. Don't get intimidated by these. We'll keep it simple. The Relative Strength Index, or RSI, measures momentum. An RSI reading below 30 is often considered oversold, meaning the selling might be overdone and a bounce could be coming. Another simple one is using moving averages, like a 9-period exponential moving average crossing above a 21-period EMA. This can signal that the short-term trend is starting to turn positive. When you combine these things, a support level, a bullish candlestick pattern, and a confirmation from an indicator like the RSI, your probability of a successful trade goes way up. You're stacking the odds in your favor. This chapter is arguably the most important one in the entire video. This is the secret sauce. You must, and I mean must, decide on your exit points before you even enter the trade. This means you need to know two prices in advance: the price at which you will take your profits and the price at which you will cut your losses. This is done by setting a take profit, or TP, order and a stop loss, or SL, order. Doing this removes all emotion from the decision-making process once you're in the trade. When the price is flying up or crashing down, your emotions will be screaming at you to make irrational moves. Your preset orders are your logic, your plan, protecting you from your own panic. Let's use a super simple example. Say you've done your analysis and you decide to buy a stock at 100 rupees. Before you click buy, you look at the chart. You see a resistance level, a ceiling, at 106 rupees where the stock has struggled to go higher in the past. That becomes your take profit target. So, you set an order to automatically sell your shares if the price hits 106. You've just defined your win. Now for the most important part, the stop loss. You look below your entry and see that if the price drops to 97 rupees, your entire reason for buying the stock is wrong. That becomes your stop loss. You set an order to automatically sell if the price hits 97. Now think about what you've just done. You've entered a trade where your potential profit is 6 rupees per share, from 100 to 106, and your maximum potential loss is 3 rupees per share, from 100 to 97. You are risking 3 rupees to make 6. That is a fantastic risk-to-reward ratio, which we'll talk about more in a minute. But the key takeaway here is that the outcome is now predetermined. Either the price hits 106 and you take your profit automatically, or it hits 97 and you take your small, manageable loss automatically. There's no guesswork, no panic, no hoping and praying. It's just simple execution of a well-defined plan. This is how professionals trade. Now that you have the core framework, let's go over a few golden tips that will tie this all together and save you a lot of money. The first is to always follow a positive risk-reward ratio. This is just a fancy way of saying that your potential profit should be bigger than your potential loss. A common one to start with is 1 to 2. This means for every 1 rupee you are willing to risk, you should be aiming to make at least 2 rupees in profit. In our last example, we risked 3 rupees to make 6, which is a perfect 1 to 2 ratio. Why is this so powerful? Because it means you can be wrong more often than you are right and still make money. You could lose on 6 trades and win on only 4, and you still come out ahead. The second golden rule is to never, under any circumstances, enter a trade without a predefined plan that includes your entry, your stop loss, and your profit target. If you find yourself wanting to buy something just because it's moving fast, stop. Take a breath. If you can't define your exits in 30 seconds, you have no business being in that trade. This single rule will prevent almost all of your impulsive, emotionally driven mistakes. It's your ultimate safety net. It forces you to be disciplined and analytical, which are the hallmarks of every successful trader. No plan, no trade. It's that simple. Third, avoid emotional exits. This is the flip side of the last point. Once your stop loss and take profit are set, let them do their job. Don't get scared and sell just because the price dips a little bit but hasn't hit your stop loss. And don't get greedy and cancel your take profit order because you think it might go a little higher. Your plan was made when you were calm and rational. Stick to it. And a bonus tip, consider using a trailing stop loss. If a trade is moving strongly in your favor, you can adjust your stop loss upwards to lock in profits. For example, if your stock goes from 100 to 104 rupees, you could move your stop loss from 97 up to 101. Now, the absolute worst case scenario is that you make a small profit. It's a great way to let your winners run while still protecting your downside. Look, if you've been watching this video and your head is spinning with support levels, RSIs, and candlestick patterns, I get it. It can seem like a lot. But if you forget everything else I've said today and only remember one single thing, I want it to be this. This is the core concept, the foundation upon which all successful trading is built. It's the difference between gambling and speculating, between amateurs and professionals. It's the one sentence that, if you follow it religiously, will put you ahead of 90% of beginner traders who are just clicking buttons and hoping for the best. It's the ultimate filter for every single trade you will ever consider making for the rest of your life. The rule is this: plan your exit before you enter. That's it. So simple, yet so powerful. Before your money is at risk, before your emotions are involved, before the price starts moving and messing with your head, you need to have a clear, written down, unchangeable plan for how you will get out of the trade. You need to know the exact price that proves you wrong, your stop loss. And you need to know the exact price that proves you right, your take profit target. These two numbers are more important than your entry price. They define your risk, they define your potential reward, and they define the trade itself. Every single time you think about buying a stock, an ETF, or anything else, ask yourself these two questions. At what price will I sell if I'm wrong? And at what price will I sell if I'm right? If you cannot answer both of those questions with specific price levels, you are not allowed to place the trade. Period. End of story. Don't even think about it. This isn't just a tip or a suggestion. This should be your law. Engrave it into your trading process. Making this one rule a non-negotiable part of your routine will force you to be disciplined, manage your risk, and trade with a clear head. It will save you from catastrophic losses and is the first giant leap towards consistent profitability. So there you have it, the absolute fundamentals of entering and exiting a trade. It's not about finding some secret indicator or a magic formula that predicts the future. It's about having a plan and executing it with discipline. Trading success comes from managing your risk, not from being right every single time. By defining your entry, your stop loss, and your take profit before you ever put a single rupee on the line, you remove the biggest obstacle to profitability, your own emotions. You transform trading from a stressful guessing game into a methodical process of executing a well-thought-out strategy. This framework of planning your trade and trading your plan is what separates consistently profitable traders from the 90% who lose money. It might seem boring, it might seem like extra work, but I promise you, the peace of mind and the improved results are more than worth it. Your goal shouldn't be to hit one massive home run. It should be to stay in the game long enough to let a series of small, well-managed wins compound over time. Protecting your capital with a stop loss is priority number one, because without capital, you can't trade at all. I really encourage you to take these steps seriously. Before your next trade, actually write down your plan. Define your risk, your entry, and your exits. See how it feels to trade with a clear blueprint instead of just winging it. It will be a complete game changer. If you got any value out of this video, do me a huge favor and smash that like button, subscribe if you haven't already, and hit that notification bell so you don't miss out on future videos. Thank you so much for watching, and I'll see you in the next one.